If you are an investor who needs confirmation bias and can't invest in a company with bearish opinions from other investors, then this video is not for you because I'm going to be looking into three different companies that I really have no belief in, that I'm personally staying as far away from these companies that I personally can. And if you can't take the heat, then just don't watch this video. But if you do end up enjoying the video, make sure to subscribe to the channel and let me know your thoughts on these three companies because I always like to hear your guys' opinions and your guys' thoughts. And again, I just want to thank you all so much. The growth on this channel has been absolutely incredible. You can see 2.2 thousand views literally just from 5 days ago. The channel has only got like 400 subs, and this is incredible stuff. So if you're new to the channel, make sure to subscribe and turn on post notifications for videos coming out every other day. I'm trying to provide as much value as I possibly can, giving you guys all the dividend stock information that I can. We're looking at my portfolio right now, and what this portfolio consists of is 24 different holdings, an average dividend yield of 3.406%, an expense ratio of 0.06%. Just because of the simple fact that in this income fund is strictly ETFs, but these are stocks. You get the gist. You can check out this portfolio if you want using the link in the description below. It'll say my dividend portfolio or just dividend portfolio. You just click that link, use M1 Finance. You can sign up, get $30 free. Once you deposit, I believe it's $100. We and me both will get $100 or $30 free. It's free money. Make sure to check it out. I use M1 Finance for my Roth IRA and my personal investing account. So enough of that talk. Let's get into these three companies and why I don't like them. So the first company I want to look at is IBM, International Business Machines Corporation. A lot of dividend investors look at this company and they will see a dividend yield of 5.31%, which, don't get me wrong, a 5.31% dividend yield is amazing. That's incredible. But you know it's not incredible when the company paying this dividend yield can't make their value and share price appreciate. They just are down 18.9% over the past 5 years, which is nothing that you ever want to see in a company. Over the past 10 years, they're down 33.68%. Just looking on some examples, if you were to invest in IBM 5 years ago, okay, 5 years ago in 2016, you would have bought the shares at $155 per share, and it's now $123 per share. If you would have reinvested all these dividends, this is assuming a $10,000 investment, you would have bought 64.22 shares. With dividend reinvested, you would have ended with 80.4 shares. So you got 16 more shares, which is some pretty solid stuff. Your total investment would be worth now $10,394. You would be getting a total return, an annualized return of 0.78%, a total return of 3.95%. You can get your money working for you far better in other investments. Looking further than why I don't like IBM, you got a relative dividend safety score of C-, which is not that good. A payout ratio of 63.82%, which is not terrible, but your dividend growth rate is not very solid at 3.91%. It increases a little bit, a little bit of hedge against inflation, but you can get far better returns. Looking onto some more stuff, they only have a profit margin of 6%. Their quarterly earnings year over year are negative 34%. That is not what you like to see. Negative 33.5% quarterly earnings growth year over year. You don't want to invest in companies that are decreasing in value, decreasing in revenue, and decreasing in their profits. That's never anything that you want to see. Now looking on towards some more things for IBM. Morningstar is giving us a fair value of $119 per share, and that means we are trading within the range of being fairly valued. However, we are $4.61 above that price. Looking on to some more stuff, their economic moat is currently narrow, which a lot of companies do have a narrow moat. Not every company is going to have a wide moat, but it has a negative moat trend rating. What does that mean? They're losing their moat over and over time, becoming a lower part of the market share, getting dominated by their competitors. And with cloud and different things like that, Microsoft, even Google, all these different cloud companies are coming in and taking market share from IBM. And I believe that in the long term, IBM is going to get dominated by these companies. I believe in Microsoft and Google and all these other tech companies far more than I believe IBM. Looking onto some more things, IBM's PE is currently 24.5, which is below the S&P 500 average as a whole, but the S&P 500's average PE ratio right now is like at 38. The market trend for the past 10 years is like 19. So kind of the whole market is overvalued right now. However, IBM's PE ratio is up 77.7% over the past 5 years, suggesting that the stock is currently priced at the high end of its historical valuation range. So if it's priced at its high end of its historical valuation range, what does that mean about the fact that over the past 10 years, it's down 33.68%? It's priced higher than it needs to be from its 10 years ago, whenever it was way higher. The revenues, earnings are decreasing, which is nothing that you want to see in a company that you're investing in, okay? Looking on these numbers onto their third quarter results, don't get me wrong, these numbers are uptrending, but you could put your money in other companies whose numbers aren't only going up by 1.9% or 0.2%, you know? Revenue of 17.6 billion is up 0.3%, but it's actually down 0.2%, adjusting for divested businesses and currency. So, not numbers that I like to see whenever I invest in a company, and that is my take on IBM. Now let's talk about the second company, and I'm probably going to get a lot of heat for this one. A lot of people don't like this. I made a video over this stock before, and the like to dislike ratio was not the best, but I'm going to talk about it because I stand next to my word, and I don't believe in AT&T stock at all. They're down 8.76% over the past year. Now I know that a lot of people, there's pros and cons. If you're a fan of AT&T, I'm not a hater on you. I just personally am not a fan of AT&T. If you dislike the video because I don't like AT&T, that's your call. You know, I'm not here to tell you to not dislike the video. You know, I hope that you like the video, but it's whatever you do. You know, it's your opinion. But we'll see right here is they have a dividend yield of 8.29%, which is very, very solid. But when your stock over the past year is falling by more than that, you're getting a negative return on your money, which is nothing that you ever want to see. Over the past 5 days, we're down 6.3%. Over the past month, we're down 8.23%. The past 6 months, we're down 21%. You get where I'm going with all this stuff. Year to date, we're down 12.73%. Me personally, I don't like to invest in companies that can't prove that the share price should be appreciating whenever you're down 31.23% over the past 5 years. Looking on their dividend safety, it's right now a D-. We know that AT&T is about to cut their dividend by estimated to be roughly 50%. You would be getting shares in another company, but that company will not be paying dividends. So if you are strictly a dividend investor looking for dividend income and income investing, AT&T stock is most likely not your best bet. Now looking on towards some more things, the payout ratio of 62% is not terrible, you know, but I like to put my money in other companies that I know are going to increase their dividend because I want my portfolio's dividend income to be increasing over and over and over again so that I know I kind of treat my portfolio as a company. You know, you want your company's revenue that you're investing in to increase year over year. And you don't want anything that's holding you back from doing that you're not 100% sure is going to pay off in the long term. I don't know if AT&T stock will pay off in the long term. They right now have a profit margin of 1% and an operating margin of 17%. Their quarterly revenue year over year has decreased by 6%, and although earnings have increased by 112%, this is kind of inflated just by the simple fact of COVID. Their debt to cash ratio is insane. They have debt of $179 billion. Now with this entire transaction and acquisition merger that's going on, we are going to see AT&T's debt decrease by a lot to like $126 billion, I want to say. But that still is a lot of debt, and I don't like the company by any means. Looking into some more stuff, AT&T's revenue is forecast to grow at a rate of negative 2.71% per year, which is not exceptional. That, of course, is not exceptional. You don't want to be investing in companies whose revenue is decreasing. But looking into some more things, they have a current PE ratio of 193, which is insanely overvalued. You know, the current index is 23.56, and the 5-year is 17.97. So it shows that AT&T stock is further overvalued. Now their net income is all over the place, decreasing, increased a little bit, decreased, only sitting at 1.1 billion. I don't like numbers like this in my personal opinion. Looking on some more stuff, earnings per share and revenue both expected to decrease over the next year. Not what you want to see when you're investing in a company. Institutions are slowly selling off. You can see there's a lot of selling pressure happening on the stock. Sometimes there's buying pressure. You know, recently there's been some buying pressure. But net overall, you're seeing a lot more selling pressure onto the stock. Now, if you were to invest in AT&T 5 years ago, what would your returns be looking like? You would have a total return of negative 8.57% and an annualized return of negative 1.78%, which is nothing that you ever want to see investing in a company. You want to have things in your portfolio that increase it and increase the value. Now, the dividends collected, you would be getting a lot of dividends. You know, technically, you would be making some money. But I don't like to play my investments like that. I want to have increases in shares because I reinvest my dividends. I want increase in investment value, and I want increase in dividend yield and dividend income. And that's not the kind of results that you're going to be getting if you were to invest in AT&T stock, historically speaking. Now, looking onto the last company is BTI, British American Tobacco PLC, with a nice dividend yield of 8.55%. That is very attractive, don't get me wrong. But over the past 5 years, we're down 38.5%, which is not acceptable by any means. Over the past 10 years, we're down 26.32%. So that is nothing that you ever like to see in a company that you're investing in. Look at all these sector relative grades. They have a D minus for dividend safety, a D minus for dividend growth, and a D for dividend consistency. So they have a dividend growth record of 5 years, which is not that strong, nothing insane. But I don't like to see numbers like this. I'd rather see numbers that prove a company is going to increase and increase and increase these numbers. If you're going to play the tobacco industry, I would recommend that you go to ticker MO. I am personally invested in that company, and I believe in the value of that far more than I do for BTI. Quarterly earnings year over year is minus 6%, and revenue is down 1% year over year. Their cash to debt is not the best, negative $33 billion, and their debt is $36.36 billion. So not numbers I like to see. Looking at these revenues all over the place, and then it went up really, really high, and now it's kind of back to its lows. So not the best things. Their net income, not that good compared to 2017 numbers. Whenever it's doing far better. The only thing on this chart that I'm actually liking is their earnings per share. However, I don't think that just because an earnings per share increase means that all these other aspects are going to increase as well. Now, looking on some more stuff, their net income is decreasing kind of long trend terms, which is not anything that you like to see, especially when you're investing in a company for a dividend. Now, net income percent decrease has dropped by 44.52% over the past 3-year annualized return, and their diluted earnings per share has dropped by 46.56% over the past 3 years, which is never anything that I like to see when I invest in a company. BTI is forecast to generate lower returns on assets of 6.78% compared to the U.S. consumer defenses industry of 42%, and the revenue is forecast to grow at a rate of negative 0.01%. You don't like to see companies decreasing their revenues, just like we've talked about. And if you were to invest in BTI 5 years ago, what would your returns be looking like? An annualized return of negative 3.56%, a total return of negative 16.5%. Of course, you would be sitting on some more shares because of your dividend reinvestment plan, but you want to have all the key aspects, not just more shares because they paid you them. You want to have the increase in share value, the increase in shares, and the increase in dividend yield. But remember, everybody, that's what I have for you in this video. So if you did enjoy it, make sure to give it a thumbs up and you subscribe. You turn on post notifications for videos coming out every other day. I'm here to provide as much value as I possibly can, helping everybody build their way to financial success. Again, thank you for making it all the way to the end of this video, and I'll see you at the next one.